Yeah, I think the key thing here is that inflation is really starting to kick in again on the input cost side. We've had a really very favourable period for the mining companies where commodity prices have been rising and costs have been pretty steady, so they've got a nice margin expansion. The market's still expecting margins for Rio Tinto to continue to expand from here. I think this result will put some questions in the minds of investors and of some analysts as to whether that's a reasonable expectation for the future. What they have done is paid down a lot of debt, but in that sense, they're not alone. The majors globally have all done the same thing. Everyone got a big fright in 2015 when commodity prices turned down, and there were concerns that, China's structural issues were finally kind of coming to a head. China economy has since been stimulated by government spending and infrastructure spending, so that's kind of been kicked down the road a bit. But in the interim, all the mining companies have cleaned up their balance sheets, so it's not an issue for any of the majors. They've all got a lot of cash and a lot of financial capacity at this point in the cycle. The hardest thing is finding something productive to do with that money. Asset prices are pretty high. If you're looking to make acquisitions, you're making acquisitions pro-cyclically. If you're buying back shares, you're doing that at a time when earnings are good, and that's reflected in the share price. So that's kind of how I see the world. The other thing that the market's kind of interested in is the $4 billion of asset sales proceeds that are going to be returned to shareholders. Rio hasn't decided how it's going to do that yet. Could be special dividend, could be more buybacks. And I guess we'll wait and see, but there's pros and cons to all of that. As an Australian shareholder, dividends are great if they're fully franked. The shareholders get the benefit of the franking credit, but that's not necessarily the case for the London listed stock. If they have buybacks, they're buying back the London listed stock a bit cheaper than the Australian stock, but you're still buying back at a time when external conditions are very good. Ideally you want to buy back when the markets what's baked into the share price is probably pessimistic, and I think at the moment we're probably on the optimistic side.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.